we have just talked about the current rate method and the temporal method. Now let's do a brief comparison of the two. So this is a comparison of the cash flow statement under the two methods. As you can see here, the only difference here occurs in the operating activity section. And actually starting from here, everything is the same, no matter which method the firm is using. And also one of the difference in under the two methods is under the current rate method, we have something called translation adjustment. So it is actually it is called cumulative translation adjustment, which is on the balance sheet. And the difference between cumulative translation adjustment is called translation adjustment. And that thing is recognized into your OCI. So what we calculate this number is, we first calculate net income, and then we use net income, the beginning of the year retained earning plus net income minus dividend, that enable us to calculate the end of the year retained earning. And then actually this is the cumulative translation adjustment. It is applied on the firm's balance sheet. And under the temporal method, which we have is called remeasurement gain or loss. And this is something we recognize on the income statement. So we first calculate the end of the year retained earning, which whatever we need to balance our balance sheet. And then we use the end of the year retained earning to calculate net income. And the remeasurement gain or loss is applied on the income statement. So those are the two different ways under these two methods, how they account for the gain or loss coming from the change in exchange rate. So when under the temporal method, it goes into net income. Under the current rate method, it goes into OCI. And also the way we calculate those numbers is pretty different. Here it just says that on the balance sheet, we have cumulative translation adjustment under the current rate method. And the change in cumulative translation adjustment is called translation adjustment. Under the temporal method, we have remeasurement gain or loss. So again, it is the same message. And previously, in order to get these two numbers, we need to work through all of the three financial statements. So is it right? That's what we did. We need to work through the financial statement in order to get those two numbers. And here, I just want to, as a little bit side like knowledge for you, I just want to give you an alternative method of calculating those numbers without going through the whole financial statement. So first of all, let's look at translation adjustment. Net income equals to common stock plus additional paid-in capital plus retained earning. Do you agree with this? So this is the basic equation, right? Net asset. Net asset is basically asset minus liability. And what is asset minus liability? That is our shareholders' equity account. And what is shareholders' equity account made up of? It is made up of our common stock, additional paid-in capital, and retained earning. So this is the basic balance sheet equation. And then, so if we take the change on both sides of this equation, that gives us the change in net income equals to the change in common stock plus the change in additional paid-in capital plus the change in retained earning, right? So this equation should also, it's just a natural, like we just take the change. And then, so the third equation is just the second equation, except that we break down what is change in retained earning? That is basically net income minus dividend. So this equation should stand as well. So the issue here is the two sides of this equation is equals under the local currency which the subsidiary made its financial statement in. So when the subsidiary made its financial statement under the local currency, this equation should balance. However, when we do the translation, when we're translating it into US dollars, we're applying different rates to different components of this equation. So for example, net asset is the difference between asset at the end of the year minus asset at the beginning of the year. However, for the asset at the end of the year, we're applying, because under the current rate method, we use current rate to all of the net asset. But the asset at the end of the year, we apply the current rate at the end of the year, versus the asset at the beginning of the year, we apply the current rate at the beginning of the year, which is the historic rate from the end of the year's perspective. And then for common stock, additional paid-in capital, and dividend, we all apply the historic rate. And for net income, this is a composition of different rates. So because it is like the way it is calculated. So now this equation balances under the original numbers. And now because we're applying different rates to this different parts of this equation. So after we have applied different rates, this equation, is it still going to balance? So the answer is no, right? It's not going to balance. And in order for this to balance, whatever we need a plug here, and that is our translation adjustment. So translation adjustment. And then the cumulative of translation adjustment is called cumulative translation adjustment. So this is the alternative way to calculate translation adjustment under the current rate method. And now how do we alternatively calculate remeasurement gain or loss under the temporal method? So it's very similar logic here. Net monetary asset plus net non-monetary asset equals to shareholders' equity. Do you agree with this? So what is our net monetary asset? That is our monetary asset minus monetary liability. And what is net non-monetary asset? That is our non-monetary asset minus non-monetary liability. So these two combined together, that is actually our asset minus liability. And that should be equal to our shareholders' equity. And then if we take change for both sides, and then we move non-monetary asset to the right-hand side of this equation, that gives us change in net monetary asset equals to change in shareholders' equity minus the change in net non-monetary asset. And further, change in shareholders' equity can be decomposed into change in common stock plus change in additional paid-in capital plus net income minus dividend. So, and the same logic here is when we have this equation, when the subsidiary is making its financial statement, this equation should, the left and the right-hand side of this equation should balance under the local currency of the subsidiary. However, when we remeasure it into the parent firm's reporting currency, we are applying different rates to different components of this equation. So for example, for net non-monetary assets, we apply the current rate. However, it is the current rate at the end of the year minus the current rate at the beginning of the year, which is like the historic rate. And common stock, additional paid-in capital dividend, we all apply the historic rate. Non-monetary asset, we apply the historic rate, and actually depend on what kind of non-monetary asset it is. It can be a little bit complicated as well here. And net income, so it is composed of different components. It is a composition of different rates. So now, because we're applying different rates to different parts of this equation, so this equation is not going to balance after remeasurement. And we need to plug in whatever we need to make it balance. That is called remeasurement gain or loss. So it's just similar logic here. So this is about current rate method and temporal method. And in next class, we're going to talk about how to incorporate all of those and how to make a consolidated financial statement when the parent firm has a foreign subsidiary.